Let's talk about lifetime learning, shall we? Speaking of talking, we talk a great game about lifelong learning. But do we actually practice it? I mean, we all had gym class in school, and then, at least I did, went through a long period where I barely worked out at all. Now I struggle with workouts, but I get them in, but not like gym class where it was all regimented and it was a part of my life. Now I have to recarve out things. But this idea of lifelong learning, gym class and never working out, politics, we quote political ideas, and I'm not kidding about this. We quote political ideas that were formed in our head when we were 12 years old. Have you seen that statistic? 12 years old is when our political beliefs were formed, and we spout them on Facebook all day. And yet, when I remember back to a past trip to Europe, we were in Marseille, and there was this Pablo Picasso exhibit. And Picasso, known for his expressionist paintings, he could actually draw a very lifelike human form, building, animals. He could draw them all very, very well. And you look at him today, later in his life, he kept moving away from that. He kept moving, he kept changing, he kept exploring. And I think that's half of some of the great achievers' genius, don't you? The first is coming up with a great idea. And the second is reiterating and redefining yourself and keeping on moving on. Live from the 3-room apartment above Uncle Jack's garage while we're renovating the basement. Hey there, stackers. I'm Joe Saul-Sehy, Average Joe Money on Twitter. And if you've been listening just to the feed, you won't know that I've been gone 2 weeks. But I'm back. I'm back sitting here in the chair. Feels weird. Feels great. Glad to be back. Did I tell you I went to Europe? But I'm recently back, and I'm ready, as we are every day on Money in the Morning, with 2 great headlines and a big idea to take you home. That's what we do here on the show. Today's show is brought to you by the Stacky Benjamins live tour. Did I tell you we're going on tour live? Check this out. We are going to 3 cities. We are headed to Orlando first on September 25th. Then we're going to Kansas City. And finally, we're coming to see you, Detroit. So for tickets, head to stackybenjamins.com/tour. We've got lots of great announcements we can tell you about, and I'll spend just a second on that later in the show as we get ready to take the show on the road. But that's coming up later. Right now, we've got some fantastic headlines. So Laura, why don't you get the party started for us?
Here come 2 headlines ripped from the financial press, only at Money in the Morning.
Only at Money in the Morning. Thanks, Laura. The place where we not only read you the headline like some other podcast, we go the rest of the way and we tell you exactly what you might want to think about it when it comes to your financial plan. I found this one interesting today in the news. This comes to us from Bloomberg Business Week. For hedge fund stars, being right in 2008 proved to be a curse. First of all, we should talk about what a hedge fund is, because maybe if you're listening to this, you have no idea what a hedge fund is. This is, we've got mutual funds, which is where you put your money in a barrel of money with a bunch of other people. It has a manager. The manager goes out and buys stocks, or maybe it's an algorithm that goes out and buys stocks or buys bonds. They tell you in the prospectus, this little book that comes with it, or even in the description, exactly what they're going to buy. You make your decision on the cost, what you want, the companies, what you want, and then you go buy it. Well, the top managers realized that they could make a lot more money by making their things a little more exclusive and kind of being able to do whatever they want. So instead of saying, hey, I'm going to buy all large company stocks, which is what a mutual fund has to be sold by this prospectus thing that says what they're going to do. Hedge fund manager, you says, hey, you're hiring me. I'm going to do whatever I want to do. If I feel like small company stocks are good today, that's what I'm going to buy. Large company stocks, I can buy the stocks. I can short the stocks, which means I can bet that the stocks are going to go down. I might be able to do a lot of option strategies. A lot of mutual funds also do option strategies, but hedge fund managers get paid a lot more money. And there have been some hedge fund managers that have made some brilliant calls. And in 2008, there were a few, and that's what this piece is all about. So there's a hedge fund, expensive way to invest, but you're buying the best. And historically, there have been some hedge funds in some years have just knocked the ball out of the park. And these are three that in 2008 did that. All right. That explains what we're talking about today. So let's dive in, shall we? Bloomberg Business Week. This is written by Saul-Sehy. It was the spring of 2008, and David Einhorn gave the most memorable speech of his career. At a conference in Manhattan, the hedge fund manager took to the stage at the standing room only concert hall and delivered a scathing attack on Lehman Brothers. The U.S. investment bank, he said, hadn't disclosed before that year billions of dollars of assets tied to loans and had incorrectly valued some of its mortgage-related assets. Lehman filed for bankruptcy 4 months after Einhorn's presentation, cementing his reputation as a money manager with a sharp eye for spotting corporate troubles. Around the same time, another New York hedge fund manager, John Paulson, was minting a fortune by betting that more U.S. subprime mortgage borrowers would fail to make their payments. Across the Atlantic in London, a firm run by a lower-profile hedge fund manager, Alan Howard, had prepared for a financial crisis by cutting risk and buying investment contracts that would profit from market volatility. The global financial crisis that unfolded in 2008 was terrible for the hedge fund industry on average. It lost a record 19%. Strangely, though, it added to the mystique of the hedge fund manager. Einhorn, Paulson, and Howard were part of a small cohort who showed foresight at a time when other investors were racing toward the cliff. And that's exactly what hedge funds are supposed to do. While regular mutual funds largely ride the market's ups and downs, hedge funds charge high fees, traditionally 2% a year, plus 20% of the profits, on the promise that their managers can outsmart the faulty wisdom of the crowd. But in the decades since the crisis, Einhorn, Paulson, and Howard have all to varying degrees lost their cachet, and their businesses are mere shadows of their former selves. They're hardly alone. The $3 trillion hedge fund industry, less glamorous than it was during its heyday, is crowded with managers struggling to justify their cost. The problem with a business based on geniuses who can spot trends is that few remain geniuses forever. Quote, regression to the mean is a very powerful force in the universe, said University of Pennsylvania psychologist Philip Tetlock, who studies the track records of professional forecasters. It's harder for hedge funds to sustain high performance in the long term, especially when you have a lot of smart people second-guessing each other. Einhorn, Paulson, and Howard declined to comment through their spokespeople. Each unhappy hedge fund is unhappy in its own way. Einhorn's tale is one of a classic value investor, the dogged researcher who digs into companies hoping to find overlooked gems or sometimes overhyped trash. By 2008, he'd already was renowned as a bold stock picker and a gadfly. He'd spent much of the 2000s taking to task a lender called Allied Capital over its accounting. He also shorted the stock, that is, bet on its price falling. He'd ultimately be proven right on Allied, and he was on Lehman, which he also shorted. Even so, 2008 proved a hard year for Einhorn as Greenlight Capital lost about 23% as the rest of the portfolio was dragged down in the historic market slide. By the way, this next sentence is the big one. So Greenlight Capital loses 23%. Listen to this. Then again, an investor in a sensible S&P 500 index fund lost 37%. Now Einhorn is struggling in a bull market. Greenlight's tumbled 25% this year. Einhorn's been wrong-footed on nearly all of his top 40 holdings. He's bet on a crash in technology stocks, including Netflix and Amazon. That hasn't happened. Meanwhile, he's been long on Brighthouse Financial, which has tumbled 31% this year. General Motors down 17%, and German drug and chemical giant Bayer, which has slumped about 31%. He's also bet on gold, which has lost 8%. Einhorn told investors in July that it's been a frustrating environment for value investors. Quote, right now the market's telling us we're wrong about nearly everything, he wrote. And yet, looking forward from today, we think this portfolio makes a lot of sense. Investors pulled about $3 billion from Greenlight in the past 2 years, leaving it managing about $5.5 billion in assets, less than half the peak of $12 billion 3 years ago. And it goes on to talk about the other managers, and I'll link to this on my Twitter feed over at Average Joe Money. So interesting thing here. 3 managers who beat the heck out of the market. I mean, if the market goes down 37%, you lost 25%. Who cares if they take 2% more in fees, right? And yet, over the last decade, all three of these managers, as the piece goes on to talk about, all three of these managers has really struggled since then in the up market. And I think that's the issue. I mean, they talk first about Einhorn, and that's the piece that we covered, the part of the article that we covered. So let's talk about him for a second. When you have somebody who's a value investor, and their job is to look for deep, deep, deep values, and you've got a market that continues to go up and up and up and up and up, a rising tide raises all ships and makes it very, very difficult for that manager to succeed in a time when everything looks overpriced, right? We've done so many articles about things looking overpriced and continually looking overpriced. And how many times over the last, 5 years now, have we said this person or that person thought that the market was finally going to head down? And Einhorn not only runs a fund that does better when the market kind of struggles, number one. Number two, he now has this street cred as somebody who called it right. And I don't know Mr. Einhorn. I don't know him. I don't know anything about him. I mean, I do know. I know Greenlight Capital. I know his fund. So I know who he is, but we didn't talk this year. We've never talked. And because of that, I don't know his strategy. But I do know that it's just difficult for a manager who has a reputation of working one way in a market that's headed the exact opposite way to succeed. Which means you kind of have two takeaways from this piece. Takeaway number one is indexing for the win? Maybe. Remember, in indexing in the down years, you go down every bit as much as the market does, because that's what an index is. An index is the market. So you're going to go down the way the market goes down. But on the other side, during the up years, you get all that too. And so if you asset allocate, meaning you put money in the right bucket for the time frame that you need it, you don't have to worry about those down years, because the money that's in a place where they're going to get hit with that volatility, that's way, way, way far away money. You don't have to worry about that much. When it comes to your short-term money is not going to be anywhere close to the market. That money should be in cash equivalents for the next few years. I'm going to say bonds, even though my co-host on the Stacky Benjamins podcast doesn't agree with having bonds there in the middle. But traditionally, it's going to be cash, then bonds, and then real estate and stocks for the long term. So that's one. Another thing is if you're going to bet on stocks, if you're going to hire, I look at hedge fund managers like racehorses. If I'm going to have a hedge fund manager betting, or I'm going to make bets on the market, realize what I'm doing. I'm trying to beat that market. And when I beat that market, there's this thing called standard deviation. Standard deviation is the amount of wiggle there is in your portfolio. So when I go down from the S&P 500 that has 500 stocks, or the total market index, which has, 2,000, 2,500? I don't know. If only there were a place I could look that up. If only there were some machine where I could look. But we do these live, so I'm not going to type away now. But my point is, when you get away from a bunch of different stocks, and you go to maybe 3 or 4, all of a sudden that wiggle gets bigger. So you really have two choices as an investor. Choice number one is accept the index. Choice number two is remember that you are picking racehorses when you don't do that. And you can win a lot bigger, but you also can lose a lot bigger. And that's why I get frustrated, by the way, when people buy stocks just because their neighbor bought it or their friend bought it. That's a fine place to start. But if you're going to buy individual stocks yourself, you got to know how to do two different types of analysis. One's called fundamental analysis, where we can dig into the company and how the company really works. How much debt do they have? How much cash flow? What do sales look like? How much money are they making for shareholders? All that stuff. On the other side, I also want to know technical analysis. And technical analysis is kind of voodoo. It's how the stock's trading versus how it's traded in the past. Technical analysis, though, because so many people use it, it works over the short term. Doesn't always work, but technical analysis is a type of analysis for a reason, and I like knowing a little bit of both. All right, I think that's going to do it for our first piece. Let's say hi to all of our friends hanging out with us in Facebook land. Hey, Facebook friends, our live studio audience, our live Facebook audience. I missed you the past 2 weeks. Let's see how everybody's doing. Chris says I need to show the wiggle finger again, the naughty finger. Finkel is Einhorn. Einhorn is Finkel, says Tim. Hey, Tim. Lori Lechner is quoting Harry Dent. Harry Dent, by the way, is a guy who is famous for looking at demographics. For people who don't know Harry Dent, but Lori says Harry Dent, quotes Harry Dent as saying, everything's going to crash. And he's been saying that for the past 6-7 years. He's been saying that. It's funny. He's been saying that for 6 or 7 years. I remember back, he has a book called The Roaring 2000s, I think, where he said that the 2000 to 2002 downturn was, quote, halftime at the Super Bowl. And he went from being super bull to perma-bear, all based on demographics and with limited success. I feel bad because I see Harry Dent and I kind of roll my eyes. I love listening to Harry Dent talk. If you ever get a chance to watch Harry Dent talk or listen to Harry Dent talk, it was super, super fun. Chris says, for every 2008 Einhorn and Faber and Paulson, there's also many, oh my God, corrections coming tomorrow. Hide here. I totally agree, Chris. These guys called it in 2008. There are people calling it last year, people calling it the year before. You know, I look at Abby Joseph Cohen, you know, banked really a whole career on calling the 2000 to 2002 downturn. And it's interesting that somebody can base a whole career on one call. And now that's not all Abby Joseph Cohen did at Goldman Sachs. She did many more things. But whenever anybody introduces you to Abby Joseph Cohen, they always said, hey, this is the woman that called it. Kimberly's here. Hey, Kimberly. Kimberly asks, what are your thoughts on companies that offer no-fee hedge fund following funds? That's interesting. I know nothing about that, Kimberly. I know zero about that. How fun is that, by the way? And there are funds that do this. So what Kimberly's talking about, you can buy, instead of buying Berkshire Hathaway, let's say, you can buy funds that kind of mimic what Berkshire Hathaway does. And some of them I really like. Like we've had Emperor Investments on our Stacking Benjamins podcast. And they've sponsored our show, by the way, on Stacking Benjamins. And I love their approach. I very much like their approach. But they're very, very, very deep value, Warren Buffett style investor. So they kind of mimic what somebody else does. But I know nothing about these funds that track hedge funds. And Tanisha's here. Hey, Tanisha. Gets me on the life tongue. I love doing these things live because it's always a circus when you try to say words live. And people have known me for a long time. Know my mouth doesn't always work the way that it should. All right, let's move on to our second piece. Second piece comes to us from financialplanning.com, the place where finance nerds like me hang out, financial planning nerds like me hang out. And this is a piece by Kelly Cruz. And Kelly has an opinion piece that says hiring can be a bigger cost than payroll if not done right. And you might wonder, because some of you, might not be entrepreneurs, you might not work for, or you might work for somebody else, you might not have your own company, but still, it's interesting when you look at companies and how they work, and when you evaluate companies, how companies treat their employees is a huge part of success that often is underrepresented by the numbers. And I'll give you an example. You look at one company that historically hasn't done well by its employees, Amazon. Amazon just created a culture where they said, hey, we're a great place to be from, not a great place to be, right? I was at the Citadel, the Military College of South Carolina, and when I was there, that was the expression at the Citadel. Great place to be from, not a great place to be. Amazon, very, very similar. They'll tell you, hey, you work at Amazon to get this experience. You don't retire from here. Use the experience here to go make money elsewhere. I think it's okay if you're going to run your business that way. Obviously, you can't argue with Amazon's success and how they've done that. That's on the plus side. Usually, though, it's on the negative side. You'll see much, much smaller businesses that fire people and fire people and fire people and fire people and go with lower cost workers and lower cost workers and lower cost workers. And it turns out that's not always the benefit you think it is. So let's read. This piece says, Kelly writes, have you ever calculated the cost of hiring a new employee? It's not cheap. In fact, research from Center for American Progress, citing 11 research papers published over a 15-year period, determined that the average cost to a company of turning over a highly skilled job can be more than 200% of the annual compensation for that role once training costs, lost productivity, and hiring expenses are counted. That's a lot of different things. Let me go over that one more time. The average cost to a company of turning over a highly skilled job can be more than 200% of the annual compensation for that role once training costs, lost productivity, and hiring expenses are counted. This could mean tens of thousands of dollars per employee. In other words, you can't afford to have a high turnover rate in your firm. Instead of greenlighting new hires to make up for turnover on your team, why not look within your organization to make the best use of the talent you have? One of the best strategies to retain employees is to invest in their training and development. Your business model is predicated on client retention. Therefore, retaining employees in your firm should be a part of that business model too. If you don't consider employee retention as an important planning issue, you'll expose your business to many negative side effects, including the following. Number one, high cost. As mentioned, high costs are perhaps the biggest downside of employee turnover. Your firm cannot afford to regularly spend thousands of dollars to fill positions in the firm. Two, lost time. The second biggest issue with high employee turnover is lost time and productivity. It can take weeks or even months to find and place the right employee in a position. Every time you lose an employee, you have to reinvent the wheel and start the recruiting process all over again. This is time intensive, takes away from productively servicing your existing clients. And three, poor team dynamics. Finally, employee turnover is directly related to poor team dynamics or a lack of teamwork. If people are constantly coming and going, it's hard to establish a cohesive work environment in which coworkers can rely on each other and work as a team. In the end, this can have a negative impact on your clients and it inhibits positive employee morale and job satisfaction. Just as adding kindling to an existing fire will make it grow, adding new employees to a firm that may be going through employee retention pains will just exacerbate the issue. Refocusing your attention to training and further developing your team's skills is a great way to utilize the talent you've already got while communicating your commitment and investment in them. Many firms we've worked with do not have a systematic or disciplined way of training and developing employees. Unfortunately, they're not alone, and industry-wide, this is starting to become a serious problem. If you want employee training and development to be a mainstay in your business plan, then it needs to become second nature to employees. 1, create and promote a culture of learning. You must establish a culture of learning where employees are encouraged to regularly identify deficiencies in their job and request training. And it goes through that. I'm going to go just very quickly through these solutions. Number 2, let your employees choose the training topics. Nobody knows your employees better than themselves. Therefore, let them choose the training that they need to do their job better. And then number 3, utilize internal and outside training resources. Formal training is the exception rather than the rule at most advisory firms, but options for such formalized programs are diverse and can include such things as certifications and designations, technology systems, training through vendor seminars, and training on firm-wide processes for critical tasks. Start mentoring programs is another one, and it ends this way. Employees are an investment, not an expense. While the investment in continuing education and training may seem expensive, it's pennies when compared to the cost of losing an employee and hiring a replacement. And the piece finishes up. I want to start off with the part of this piece that has nothing to do with you owning the company. Because for a lot of you out there, you don't own the company. So you're like, what does that have to do with me, Joe? Well, number one, like I said, if you're evaluating companies to invest in, looking at employee turnover is a great way to look at that company. By the way, if you do business with companies that are turning over a lot of employees, there's something wrong there, and it's coming from the top. I've been on record several times saying that some of the worst financial planners that I've ever seen have had just horrible staff problems. And if you have a financial planner who can't seem to keep staff people, there's something wrong with your financial planner. Because if that person can't keep good people, there's a reason these people leave. They want to believe in the person that they work with. And sadly, now that might not be the only reason. There could be a myriad different reasons why people leave. But if you see a lot of people leave, usually the problem comes directly from the top. But let's talk about grabbing the bull by the horns and looking at your own career. Think about these things. Turn this around and say, in my career, and getting back to Kelly's solutions. Number one, have I created and promoted a culture of learning? And we'll just add in my life to that. Do I have a culture of learning? Am I constantly looking for new opportunities to look at the other side of what one of my mentors called the cube, right? We look at one side of the cube, other people look at the other side of the cube. How can I look at things in different ways so that I have a better view of the universe? Number two, let your employees choose the training topic. Think about how powerful this is for you. You choose the training topic. Now, if instead of waiting for your boss to train you on something, you say, what do I need to learn next? The sad thing is what most people do, they go learn more about the thing they're already good at. Let's do the opposite. Let's take a look at those things that might be your Achilles heel and focus a little bit on those. Number 3, utilize internal and outside training resources, meaning I might hire coaches, I might read, I might listen, audiobooks, podcasts, come at the problem from different ways. By the way, a lot of people avoid coaches. And it's funny because when you look statistically, people that do worse in their career avoid coaches. People who do better in their career generally have lots of coaches. And not long-term coaches. A couple of years ago, we had Tony Stubblebine from Coach.me, and one of the early investors in Twitter was on our show. And he said, we think of coaches as being a lifelong coach. But instead, if we say, Lori's good at this one thing that I need in my life, and she teaches me for the next 6 weeks how to do that thing, maybe I have a coach just for that one thing. Next piece of this, start mentorship programs. So once again, getting away from the work. Who's mentoring you? Look for mentors. By the way, it doesn't matter how old you are. Look for mentors. At 50, I have mentors that are half my age when it comes to video, when it comes to doing social media. Look for people that are skilled in that area and have them mentor you. And people are happy to do it. It's always so fun to work with a mentor. It is a great time. I love mentoring people, and I love being mentored in other areas. I found those to be exciting. On the other side, I think the big takeaway, if you do own a business, by the way, training and customer value, often not linked as much as they should be, and they really should be. Let's say hello again to our friends hanging out with us on Facebook. And Lori has a comment. I know you bring up the Citadel when talking about the culture at Amazon. Yeah, there's a little bit in common there, Lori. Now, not completely the same. I think I'll take what the Citadel teaches over what Amazon teaches any day. But there sometimes is a bigger moral backbone. By the way, that's my opinion. A bigger moral backbone at the Citadel than there is at Amazon. Some of the things you'll read that Amazon has done to companies. But read about what Amazon did to Toys R Us. It's a fascinating read, and it is corporate Darwinism at its best. And some people might fight with me and go, you know what, Joe, that's the way business works. And it probably is. And by the way, shame on Toys R Us for giving another company the keys to the car and saying, hey, we're going to sit in the back seat. Oops. Bad. Ended up bad for them. Chris is back. Chris says, I'd love to offer this article up to my employer. There needs to be more thought added to the work, not more tasks and meetings and profit drivers. You know what, Chris? I will message you this piece afterwards. I'll also put it on my Twitter feed for everybody. I completely agree. More tasks, more meetings, more profit drivers. Not as exciting as cross ad hoc committees, right? One of my favorite gurus, Tom Peters, talks about ad hoc committees and cross-function lunches where you're working with people that don't normally work together. And instead of saying, hey, these, the accountants at my company stink, or the people in another department stink, instead, all the departments kind of working together to bring the whole ship up. I think it can be a hugely powerful thing. More training, more communication. And by more communication, I don't just mean more meetings. Chris says, mentorship's a good buzzword. I wish a lot more companies would give into it. Starts from the top, doesn't it, Chris? And sadly, the top isn't always, they pay lip service to it. I worked for a company one time, maybe 25 employees, and the manager loved to use the buzzwords, never did any of it himself. And because he didn't do any of it himself, the rest of the company didn't really do anything. They kind of paid lip service too. Lori says, a very successful and smart businessman once said to me, I strive to be the dumbest person in the room, and that way I'm always learning something. Pretty good advice. Very good advice. And actually, Lori, you're going kind of where I'm going with today's big idea. And today's big idea is where we take these two pieces that we just talked about, we'll put them together in one big idea for you to take home with you. But first, I promised you more on the Stacky Benjamins tour. And I want to point to one thing that I haven't talked a lot about yet. TIAA is coming with us on this tour. And TIAA is celebrating 100 years of being in business, being a nonprofit, working with individuals. They were founded by Andrew Carnegie. You don't know who Andrew Carnegie is? That's a whole different episode. Just use Wikipedia and you'll find out a lot. But Andrew Carnegie was tired of teachers being destitute and hoped to help teachers save. And since then, TIAA has worked with a bunch of people. But this isn't a TIAA commercial. What's cool that TIAA is doing on our tour in all three cities is they're not talking about themselves. They're talking about difference makers in each of these cities, smart people in the cities that are making the community better. So we talked a little bit today about community. Making the community better are some really powerful people. And you're going to meet them as part of our show if you come to Orlando on the 25th of September. If you meet in Kansas City on October 9th, and then on October 24th, we'll be in Detroit. And if those three shows go well, guess what? We're going to do it next year. So hopefully we're coming to a city near you in the next few years. And we've been designing the heck out of this show. It's going to be similar to the Stacky Benjamin show, but because we can do things video-wise, we're live. We can do some different things that involve the audience more. I can't wait. It's going to be a great time. StackyBenjamins.com/tour for more. Hope you can join us. All right. Time for our big idea today, guys. How the heck am I going to take these two pieces? So let's go back. The first one was about hedge fund managers that called the downturn in 2008. Not doing so well today. And maybe the takeaway there is indexing. I think the bigger takeaway is if you're going to hire a manager, if you're going to pick stocks yourself, realize that wiggle, the up-down, going to be much, much bigger. So if you're going to try to beat the market, there's a good chance you're going to lose there. The second takeaway, how do good businesses lower employee costs? Training and customer value, our big takeaway. But what do we get out of both of these? And that's today's big idea. And I think for us, the biggest takeaway is this, that when it comes to value and when it comes to companies either right now or over the last 5-10 years, like we talked about in the first piece, whether it's working with employees, whether it's deciding where the market's going to fall tomorrow, this idea of embracing change. The biggest thing I've come across in my career is a huge number of people who don't like change. And yet the one constant we have in life is that things are going to be different tomorrow than they are today. And the second that you embrace that, I read today, speaking of Tom Peters was talking about politics, about people say, everything's so political. And he said to embrace the politics of a situation. In other words, to realize that it's all around you and it's a fact of life. And the second that you realize it's a fact of life, then it becomes a whole different thing. And change is a lot like that. It is not just the change that you should have, but the fact that it's okay for other people to change too. I think we hear politicians talk about flip-floppers and we think we have to dig in on our point of view. I love what Annie Duke said when she came on the Stacking Benjamin show recently. She's a professional poker player, was. She said that we're so busy telling other people our point of view is right, we aren't looking to be correct. We're not wondering how to be correct. So embracing other people's ability to change and realizing that instead of firing your employee, making them stronger, making yourself stronger, looking at your own ability to grow and learn and other people's, it's wonderful. It's a wonderful way to live your life when you realize that you know very little. Isn't that a quote, by the way? The more we know, the less we know. I think that's a fantastic revelation and a great big idea for today's podcast. Thanks for hanging out with me, everybody on Facebook. Thanks for everybody listening. Let's go stack some Benjamins. We'll see you next time back here at Money in the Morning.
Money in the Morning is created by Joe Saul-Sehy and comes to your ears because of the collective genius of our producer, Richie Rutter-Reese, engineer, Caden Thompson, and a pack of very well-trained ferrets here in the basement. You'll find links to all of our headlines featured on today's show in Joe's Twitter feed at @AverageJoeMoney. I know you already know this too, but Money in the Morning is for entertainment purposes only, and you shouldn't act on anything recommended by a bunch of entertainers in a basement without first consulting with your financial advisor and second, having your head examined. Have a headline you'd like us to discuss? Send them to Joe at stackingbenjamins.com or put them on our Stacking Benjamins Basement closed Facebook group. This show is copyright 2018 Stacking Benjamins LLC, all rights reserved. I'm Joe's mom's neighbor Doug, and I reserve the right to always say, we'll see you next time back here on Money in the Morning.